Good morning, guys. How's everyone doing today? So my name is William Echevarria. I'm an educator, I'm an investor, and I'm a visionary. So today, what I would like to go into is some tax strategies with you guys. As you all know, this was the week for taxes, okay? And a lot of people probably have been stressed. A lot of people despise this date. I know that personally. I don't look forward to this at all. All right. And what I wanted to do, I got you. Thank you. Sorry about that, guys. So what I wanted to do was go through the ideas, some of the processes that I go through, the mindset, and then from there, see what you guys have to do. So just to let you know, I will ask for a little bit of participation. So there are some questions in there that I would like to throw out to you guys. It's not a whole lot. It's not crazy questions, right? But I would like some feedback so I can actually understand that you guys are following along with what I'm trying to show you. Okay. So as you know, this was the tax season for 2022, 2023. So a lot of you guys have probably already filed your taxes. If not, you have to do an extension this year, right? And what comes from that is the repercussions of it. Okay, so some of the things that I wanted to share with you guys are things that I have learned myself, throughout the years. And full disclaimer, before I give you any other feedback, I'm not a financial advisor. I'm not a CPA or an accountant. So don't hold me liable for anything that you're about to learn today. Do your own research and your own due diligence, and definitely take these things with a grain of salt. Okay. With that said, let's get into it. All right. So if you guys know what the marginal tax rates are, if you talk to an accountant, if you talk to any kind of CPA, they're going to basically tell you what your tax bracket is. Okay, if you've been following this for the last couple of years, you're going to understand that the tax bracket and the laws, they change month after month, year after year. So you got to be on top of this so you can understand how to strategize for the following year and so on and so forth. So right now, this is pulled from the IRS literally a couple minutes ago. All right, so the IRS provides you tax inflation adjustments for the tax year of 2023. Okay, I just want you guys to be aware of where you find this information at. I like to go directly to the source. I don't like to go through a third party because it's like that phone game, where you whisper something into one person's ear and about like a dozen individuals later, that message completely changes. So for that, just go straight to the source, get the information right from them. Okay, so I want you guys to get aware of this and definitely focus your attention in the highlighted area towards the bottom. Right there, you can actually see what the tax margins are. Okay, what that means is when you start making your income and you fall within these ranges, that's what you should expect to set aside already to pay Uncle Sam. Okay, so, and then here's another chart. Okay, this chart is for the CPI rates. Now, again, I know this is not sexy, guys. This is not fun. This is just more of food for thought so you guys understand where a lot of this stuff is coming from. Like if you're in the South Florida area in Miami right now, you're noticing this craziness is happening where I don't fully understand it, but we're at a gas shortage. Right now, anybody who is driving around anywhere is basically strapped to the pump. They're looking for any gas station that's available so you can stop in there, fill up. And I'm not understanding why. And on top of that, the prices are skyrocketing. In addition, I'm like, this is just my conspiracy theory, but do you guys see a single fuel truck anywhere? Do you guys have seen, a tanker at a gas station? Like, where is this shortage, and how come we're not seeing it basically getting filled up at all? That's just me. I don't see it. My wife doesn't see that at all because she has an electronic vehicle. Okay, but either way, what this chart shows you right here, the consumer price index, what this is essentially the rate of inflation. Okay, this rate of inflation is showing you on a graph just how expensive things are getting. So if you remember, now is essentially the gas prices are going high. A couple months ago, it was the price of eggs. Last year was the fact that interest rates and so on and so forth. And if you see the chart in the bottom, okay, this chart over here in the bottom is showing you historical rates of inflation. As you can see, it goes all the way back to 1960. Okay, if you see in the middle here, you see the line chart. you see that the consumer price index was somewhere around 2 when they started tracking it, kind of went down. Then in 1970s, it started spiking up to over 10%. The highest was around 1980, where it was somewhere between 12 to 13% in there. And then it kind of started tapering off and kind of hovering somewhere in that 4 range. And then recently, if you look at the bar at the bottom of it, you can see where it starts getting darker, the shades of purple, where it got to its highest in June of last year at 9.1. And then slowly they've been tapering off, and eventually now they're hovering at 5.0, which is what they've been reporting as of this report right here. Okay. So I want to give you this idea, because what ends up happening is when you understand where the consumer price is, everything is going to start going with that. Okay. All the prices of everything is going to start getting way more expensive, right? So this is where you have to start allocating your money, strategizing where you want to put it in, investing, because if you keep on putting this money into a bank account, you're losing money just day over day. Okay, that is a negative arbitrage right there. If essentially everything is going up at this rate, 9%, 8%, 8.5%, 7%, so on and so forth, and you put your money in the bank and the bank is barely giving you 1% of interest on the money you have in there, you are losing money by just leaving it in the bank. You guys have probably heard this all over the place. You've heard it on social media. You've heard it on TikTok. Your friends have probably said it. It's kind of like old habit where you have conversations with individuals and they tell you this. It's true. The numbers don't lie. You look at it. You can put it in there if you want to for convenience sake, but you're losing money. So unless you like the game of losing money, take it out of there and put it somewhere else. Okay? Now, here's the example that I wanted to tell you guys, okay? So be ready to answer some questions, please. Definitely put them in the chat, and I would like to open it up so you guys understand this. All right, so we're gonna have the one goal of everybody likes to make 6 figures, right? So the first one is the $100,000 goal. All right, so with this, there's a misconception about what people end up actually paying for their taxes, right? They think that once you fall into a tax bracket, that's it, and that's the amount that you pay. However, when you look into it a little bit more, and I implore you guys to go into this page, do your own research, and definitely read this so you understand it, you're paying depending on what tax brackets you are breaching, okay? So if you look at this, the very first question that I want to ask you guys, looking at that chart, and please drop the answer into the meeting chat, how many tax brackets do you see? I'll give you guys just a few more seconds to look at that. Any takers? Come on, guys, don't be shy. I'm like, you're not gonna get basically an F for this. This is a teaching opportunity. All right, so if you look at that, I have 5 areas shaded for you, right? You have the 12%, 22, 24, 32, 35, and there's another one in the bullet right above that. The one in the bullet above that going for 2023 is 37%. All right, so the answer for number 1 is 6 tax brackets. You guys see that? Give me a thumbs up or 1, something, just to make sure you guys are paying attention and you're actually picking up what I'm putting out. Guys, anything? I'm like, you guys too shy this morning? What's going on? I'm like, are you dragging? No coffee, no anything?
Scary. I think some people are traumatized from taxes.
Yeah, I'm like, the taxes kind of like, what happened? Okay. All right, guys. So the next question that I have in there, what is the marginal tax bracket for the $100,000 base salary? And mind you, the caveat here is without any deductions. We're not even going to get into that conversation about deducting anything right there. What do you guys think the marginal tax bracket is for that $100,000?
It's 30, the 32, right? The 32%?
No, ma'am. Look at that real quick.
Oh,
right?
sorry. Hold on.
Yep. If it says 32% for incomes over $182,000, all right, and if you're married, it's $364,000, right? So we're going to be at the one just below that one.
For the 24, yeah.
Correct.
Sorry, it's tiny.
Now,
I'm trying to read it.
yeah, I'm sorry that you probably don't see that. So, but yeah, so that bullet, if it's hard for you to read, let me read it out for you. It's 24% for income over $95,375,000. That's single, or for a married couple filing jointly, it's $190,000. Right? So now that brings us into our third question. So what is the amount due for the income above 95,375? So this is where a lot of people kind of like get the misunderstanding of how the tax brackets work. We're not asking you that it's due a whole $100,000 and basically find the 24% of that. It's 24% of anything over $95,000. So do you guys get that? All right, so here's what we're gonna do. Okay, simple math. Open up your calculators if you guys got it with me. Okay, I want you to punch in $100,000. You guys see that? Okay, subtract that by the 95,375. That comes out to $4,625. Okay, that's not what you're paying though. That's the taxable income. Okay, now that is where you're going to pay the 24%. Anything that goes over that. Okay, so times that by 0.24. That's how much tax is liable on the amount over $95,000. Does that make sense? Right? So that's the biggest misconception about this chart. What happens is you're paying depending on the bracket that you're in, and then what it comes up, and then you aggregate all of that together. Okay, so I'm not saying, and I don't want to be misunderstood on this one. I'm not saying that when you make $100,000 that you're only going to pay $1,000 in taxes. That's not at all what I'm saying. Okay, it's very clear that I want to be very clear that it's from $95,375 all the way up to $100,000. What you're paying is at $1,100. Okay, you guys understand that part? Now, everything from that, as you can see from the chart, this is where you start aggregating all this together. Okay, so you're paying 12% of your income for anything over $11,000 all the way up to $44,000. Then once you hit the $44,000 mark, okay, now you're going to pay 22% for everything above that all the way to 95. Then when you hit that 95, then you're basically going to pay everything 24% from 95 above that. Does that make sense now? Okay, so babe, I would like to ask you to join me real quick if you can unmute yourself. I want to ask a question that we've learned throughout the process of talking with our accountant over the years. Okay, so as you're making your money and you're strategizing for next year, making your goals, like I want to make my 6 figures, I want to make my 200, my 300, whatever it is, okay? You guys got to start already setting that money aside, right? Because you definitely don't want to get surprised at the end of the year when Uncle Sam and your tax advisor tells you, like, bam, you're hit with a 24% tax margin. And you're like, where am I going to get this money from? And now you're stressing because you're like, I got to make more sales. I got to do this. I got to get to Uncle Sam. You know, I got to make sure I get paid. Okay, here's what we're going to do. So, babe, when we talk to our accountant, Bobby, okay, Batia, I could definitely drop his contact in there if you guys are interested. But what does Bobby basically tell us to do as a rule of thumb to save throughout the year?
I mean, we definitely have to set aside some funds, a percentage of our pay each time, or at least, you know, the individual business, right? So if you're a W-2, you're already paying your taxes, but if you're 1099, we're putting aside some money, you know, rule of thumb, 30% of your earnings. Also, we have to pay our quarterly dues every quarter, no matter what.
So as you can see, that's just a good rule of thumb, guys. Okay, so we're just setting aside 30% of our income essentially just to pay Uncle Sam. Okay, and while we're waiting on those quarterly dues, you can put into an account like a high yield savings account, just so it can grow a little bit of money for you. You know, it's not going to be life changing unless you have a big bucket of money, but it just helps, right? It's just these little strategies so you can get some extra cash in there to make your quarterly dues. And as you can see, 30% is pretty good because it covers you all from the 12%, the 22%, and the 24% tax bracket, right? And if you're really, really good, if you're making, from $182,000 and above, now with 30% saved aside, you still got enough money, right? And once you're making already like over $231,000 individually, or 462 as a married couple, I'm like, you're not that far off and you're making a good amount of money, right? At least it's not going to be so much of a heavy burden for you to make your payment, quarterly or at the end of the year. All right, so these are just good rules of thumb. So that 30% that Jeannie had just mentioned.
Can I add something to that? Oh. Hold on. He's frozen, right? Are you guys there?
Yep.
Yeah, okay, hold on. Let me let him know. He's frozen. Hold on. Okay, well, while he works on that, guys, I wanted to kind of chime in because I understand, like, if you guys are realtors and we're going through this journey together, right? As far as like, how do we pay ourselves? Babe, I wanted to add a little insight of something that helps me is that I always keep things separate. So I have a separate business account. For example, everything that I get commission-based from my real estate company, it goes in there. I do all my bills, expenses from that, but I also pay myself like a salary. So early on, in our lives, we set like a standard salary. Let's say I give myself, 10% or 15% of the paycheck. So that's my salary. And so I almost structured it at one point. It was like a bi-weekly thing. So it was like I'm getting paid like an employee. And so that kind of helped me because it gave me a salary, and it also kept everything very organized in the bank account. So I had my taxes, I had my expenses, I had my salary, right? And everything else stayed there because that's the profit of the business. So I wanted to share that with them as well, that there could be a structure that you can set up to help yourself stay organized. And it makes things so much easier when you're doing taxes as well.
Thank you for that. I know I dropped off for a second there. I had a hiccup on my network, so I'm not sure what you guys left off with. Babe, if you don't mind telling me what was the last thing that you guys heard, and then I can pick up from there. All right, so to follow along, guys, with what Jeannie had just mentioned, right? Definitely having a separate account is wonderful, right? Because it just makes things a whole lot easier as far as for tracking. If you're blending all of your stuff together, that's bad accounting practices, and also it doesn't really save you in the long run if you end up having, let's say, unforgiven or a lawsuit of some sort, right? If all of a sudden somebody ends up suing you for whatever reason, and you're commingling your business assets and finances with your personal finances and assets, it doesn't matter whether you have an LLC or not, because what's happening is when they set that evidence in front of a lawyer or in front of a judge, and they start looking at all of this stuff, they can't tell the difference between what's a business expense and asset versus a personal. So because of that commingling right there, they'll just say, hey, everything that basically is in these accounts is fair game. Okay, and you don't want to do that, right? So what you definitely want to do is open up your own bank account, move it over to the side, grab a checking account or a credit card or whatever, and then just be very strict and methodical about your expending and earning that way. That way, it not only makes it easier for the accountant, makes it easier for you. You can save your money. It makes it even protected in the event that you do get a lawsuit, right? So now you're protected, because in this example, what ends up happening is now you get in front of a judge or a lawyer, and they start looking at your assets. Because it's very clear, there's a real clear line in the sand. They can look at that one business account. They're like, okay, in this business account, there's this bucket of money, and this personal account is this other bucket of money and assets. They won't even look at your personal stuff. They don't care about your car unless it's a business asset. They don't look at your house. They don't look at your personal bank accounts. None of that fun stuff. They only look at the business assets because that's the only thing that basically is at risk at that point. That's your exposure. So that's the benefit of separating the two buckets that way. Okay. And then to follow along with these tax strategies, okay, here's the big thing about the W-2 and the 1099 that I want to break it into you guys. Okay. With a W-2, it's very, very easy, right? It's easy for everyone. It's easy for you as a client. It's easy for the accountant because all you end up doing is you put all of that on the employer. The employer has to track all of that, your hours, your taxes, your withholding, your benefits, your social security, all that fun stuff. And at the end of the day, they issue you one document with one number that basically sits in one little block, and that's all it cares. Right. So for you as a consumer, it's very easy for you to just go to turbo.
Oh, sorry, guys. Something's happening with his computer, I guess.
Income child tax credit, maybe some medical bills here and there if it's really high. And that's pretty much about it. Right. And then the fair share.
You froze for a little bit there. So you had a time. I don't know where we left off. I was trying to let you know.
Gotcha. Thank you. So the biggest weakness right there with being on a W-2 is that the fair share that you're supposed to pay for the government is determined by the government. And guys, I don't know about you, but if you look at the national deficit and you notice that that time clock is going off and we're like in trillions of dollars in debt, the government doesn't know how to manage money either. So how could they possibly tell me how to manage my money? I don't believe that at all, right? So what a lot of people end up doing is they go to 1099 route. Everybody's romanticized by the idea. They love it. It's sexy. I get to be the boss of my own stuff, but here's the thing that I definitely want to put in perspective for you guys also. On the 1099 side, here's the strengths. You got itemized deductions that you cannot do from the W-2 side, okay? What that means is you can expend a lot. So when you start breaking it down, two of the big concepts that I want to explain to you guys is on the W-2 side, you earn first, you pay taxes first, and then you live off what's left. Okay. Then on the 1099 side, here's the best part about it. You earn, then you expense everything first, and you pay taxes on what's left. Very different concept right there, and you see that there's strengths to that. All right, if you guys haven't, all right, so there's a question that Jeannie dropped in there. If you guys haven't opened up a business bank account, please do, to keep your business and personal separate. That's the biggest advice, for sure, 100% on that, okay? So back to the W-2 and 1099. All right, some of the weaknesses on the 1099, though, are that you have to make quarterly payments. If you miss your payments or if you miss your deadlines, your penalties are imposed on there. And then also the last one is that there has to be some forethought to this. This is not a reactionary type of thing. This is something that you have to be proactive. You have to look already towards how you're going to make the money the rest of this year and then some of next year. Okay, and you need to already start setting that money aside. Like Jeannie had mentioned, a good rule of thumb is 30%. So when you get your commission check and you look at the fact that, hey, I made a $10,000 commission check, that's great. 30% of that, though, you have to already set it aside to Uncle Sam. So instead of going out there and trying to put a down payment on a brand new car, just think like, hey, we're living life large, put that $3,000 aside, that's not your money. Automatically think about that. You got $7,000 to do what you have to do. Okay, your expenses for your company, the live off of that, your bills, so on and so forth. But that $3,000, set it aside. Put it somewhere where you can make a little bit of money until you have to make your first quarterly payment. Okay. Now, on the W-2 side, like I already showed, the weakness is you have no control over anything. Because really, what are you itemizing? You can't itemize your cell phone. You can't itemize mileage. You can't itemize, haircuts, clothing, allowances, none of that stuff, right? So essentially, there's no benefits to that, right? Lastly, that fair share. Again, what is a fair share? That's completely subjective, right? Your fair share is brought to you on that chart, like I had mentioned. However, when you're on a 1099, you have control of what part in that chart you want to be in. Okay, so if you want to say that you made $100,000 that year, well, then that's what your expenses are. And again, that's a strategy. All right, you can basically manipulate some things however you want, as long as you're, doing things legally. I'm not advising or advocating at all to start hiding numbers from Uncle Sam or cooking the books. That's not at all what I'm saying. But the thing about it is, if you're right there, let's say at that $95,000, and you know already there's an extra $1,000 you got to pay to Uncle Sam, well, then go to the store, go buy something so you can expense it for your company that you've been holding off on. Go buy that brand new laptop, that's necessary. Go buy that one upgrade. Go buy your swag gear or whatever. That way, it's a necessary business expense. Now you just dropped it to another tax strategy. I mean, another tax bracket, and now you're not paying Uncle Sam that much money. Does that make sense to you guys? Now, here's the other thing too, that a lot of people think they're slick. All right, as you see my little stick figure in the corner, all right, where he's sitting there with a double-sided sword. Okay, the thing about it is that a lot of people don't think, all right, and you want to get ahead of this before you get caught and you're like in an aha moment. All right, there's a double-edged sword to that. There's a lot of benefits to it, but the biggest drawback to that is people who try to milk the system. There's people who try to expense everything and anything, right? Because they want to owe Uncle Sam as little money as possible. What does that do for you, though? If you make, let's say, $200,000 a year and you expense $170,000 of it because you think you're being super slick, I bought a car under the company, I put a lease on a building, I did this, that, and the third, blah, 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 the whole nine, right? And you only want to pay $30,000 or you're only liable for $30,000 worth of income for Uncle Sam. What's going to happen now is when you want to make a major purchase, let's say that one luxury item, let's say another house or something like that, when they look at your income statements, they're going to say, well, you only make $30,000. There's no way that you can potentially pay for this loan. So that's the double-sided sword of that, is it you got to find a balance in that. And in the W2 side, you don't have that ability. And the 1099, you completely have that. So if you guys are now looking in this year like, hey, I want to get into my investment property, I want to get into another residential, I want to move out of here and upgrade my living standards. Well, what is it, that income that you need to make? Right? If you have an income or a house that's, let's say, $500,000, what does that income need to look like? And that's what you're aiming for. You're completely planning ahead, guys. You're completely planning ahead, and you're also putting into effect the expenses that you have for your business. You want to grow your business. You want to scale it. If you're making the same numbers that you were making last year, you're not growing, right? You guys are always supposed to be like, okay, how do I double my income from one year to the next? How do I double my income, right? You keep on doing this. Eventually, you're going to get into your exit strategy where you can either sell the company off, go live in your private island, whatever your dream is, you can actually like live it. Right? But you got to put these practices in play right now. So now that tax season is done, a lot of you guys might be looking at the fact that, hindsight's 2020. I wish you would have told me this like a couple weeks ago. But here's the thing. This is day one now. Okay, now you got the rest of the year to use these concepts and start planning. Okay, we're already in April right now. So the first quarterly was already due also if you're in 1099. Okay. Now we're going to come up on the second quarterly payment, which is going to be due in June. Okay. Yeah, that makes sense. All right. In June, basically, you're making your second quarterly payment. If you look at your numbers and you're already on track to make that $100,000, guys, start putting your math already to work. Okay. Start putting your money to the side, start allocating these funds already, start being in control of your destiny. That way, you guys feel a lot more comfort, the stress off of you altogether, and everything just makes a whole lot more sense. Okay, guys, so that's what I got for you this week. Okay, if you guys want to know more information, I'm leaving this link in here. Please go in there, put your information in if you would like to know more. I have a network, an extensive network of individuals that have impacted me and Jeannie's life, that they know money a whole lot better than we do. Okay, and even though what we're dropping to you guys right now is liquid gold, I know that, and I'm sharing it with you guys. So put that information in there. Let's have a personal conversation on one-on-one, and then we can figure out how we can get to that next level. Okay, guys? So with that, I'm going to sign off. I'm going to definitely give you guys a farewell for the weekend. And if you have any questions, definitely drop them in the chat. If not, have a good one, guys.